Hi, I'm Nick Doyle, and today I'm going to talk about a much debated subject in investing, that is, should you invest in international stocks? Today we are going to talk to two different investors, Joe and Raj. Joe believes that investors should only invest in US stocks, while Raj believes investors should have a global portfolio with both US and international stocks. Before we start the discussion, I just want to remind you that this is for entertainment purposes. None of us are professionals, and this should not be considered investment advice. Before we start the discussion, I just want to remind you to smash the like button for the YouTube algorithm. Let's start with Joe, who's going to tell us why he thinks we should only invest in US stocks. Hi Nick. While diversification is great for any investor, international stocks add little extra diversification benefit while significantly increasing the risk of a portfolio. Historically, there is a much lower correlation between US and international stocks, meaning they went up and down in different years and by different amounts. This led to a better diversification benefit for investors. Due to the shift to a more globalized economy, this correlation has almost disappeared over the past couple decades. US and international stocks trade very similarly to one another. Investing in a company is risky enough. Now add in extra risks like political or economic risks. Think communism or different accounting practices or corruption. These are risks you simply don't need to add to your portfolio. US companies operate in nearly every country in the world and benefit from international diversification. The US has a superior economic and business environment. The legal system, the political system, and the taxes are the best in the world for companies. And this is reflected in the nearly 4 times outperformance of US stocks in the past 10 years. They've delivered nearly an 11% yearly return, while international stocks have merely returned 3%. Betting against the US by investing in international stocks is foolish. The US has the best economy in the world. It's the biggest economy with the world's reserve currency, some of the strongest companies, and the best overall returns. You don't need to invest in international stocks. Thanks, Joe. Those are some great points. Now we're going to go and talk to Raj, who believes that you should build a global portfolio with US and international stocks. Hi, Nick. Let's say that Apple was the best performing stock in the last decade. I could make the argument that Apple is the strongest company. It's delivered the best returns to investors. It has some of the best products out there with a cult following, and it's well diversified, has a wide product portfolio, and it sells in nearly every economy in the world. Therefore, why invest in any other company? Apple is the superior company, and it has proven to be over the past decade. Well, just like you wouldn't want to invest all your money in one single company, no matter how successful it's been, you don't want to invest all your money in one country for the same reason. Did you know in 1989, the leading economy in the world was Japan? Their stock market, the Nikkei, was valued at 40,000 points. And now, 30 years later, it's valued at roughly 20,000 points. It has lost over half of its value, and an investor that was 100% invested in Japan, which was the strongest and leading economy in 1989, has suffered due to the lack of diversification. Nobody knows what the future holds. In investing, we say, past performance is not indicative of future gains. The idea being that you can use past performance to guide your decisions and make rational judgments, but you shouldn't count on the future replicating the past. You need to look at the current information and what the best strategy is. Nobody knows if international or US will outperform in the next 10, 20, 30, or even 40 years. In the past 100 years, there have been 10-year periods in which internationals outperformed the US and vice versa. Nobody knows what's going to be true going forward. It's best to diversify and hedge against the risk of investing in a single country and having all of your investments based in a single currency, even if it currently happens to be the world reserve currency. While it's true that US companies operate internationally, the US market is heavily skewed in certain sectors. For instance, the tech sector is overweighted in the US. Did you know that 7 of the 10 largest auto companies are outside the US? And 8 of the 10 largest metals and mining companies? This holds true across other sectors. And to build a very well-diversified portfolio, you should invest globally. This will set you up to take advantage of the global growth in the economy, regardless of which country is doing better relative to another. And no, you don't have to bet against the US to do so. The global economy can grow with the US and the rest of the world all winning. While US and international stocks have become more correlated over recent decades, there's still enough of a diversification benefit to lower volatility in your portfolio and potentially boost your returns. The best thing we can do is to build a well-diversified portfolio, and it should be a global portfolio. Thanks, Raj. Both Joe and Raj make great points. So which one do you choose? Do you invest in international stocks or not? This is a very personal decision, and it's based on the types of risk that you want to take as an investor and what your personal preferences are. I tend to side with Raj on this debate. I believe in the benefits of diversification and spreading my risk across multiple countries and currencies. There are 2 points that were made that we should dig into a little further. The first one is the correlation between US and international stocks. As you can see, over the past 50 years, there have been periods in which US has outperformed and international has outperformed. The difference in that performance has decreased over time. This does decrease the benefit of diversification, but there is still a benefit. One of the benefits to having components of a portfolio that are going up and down at different times is the decrease in volatility it brings to your portfolio. The volatility is how much your return varies over time. For instance, if you get a 10% return one year and a negative 10% return the next year, that's more volatile than getting a 5% return in each year. When you have a less volatile portfolio, even if you get the same overall average return, your overall return will be higher. Let's take a look at an example that illustrates this. Let's say you start with $100 and you invest it for 2 years. In scenario 1, we have a 30% gain in year 1, followed by a 10% loss in year 2. After year 1, you would have $130, and after year 2, you would be left with $117. This is an average return of 10%. You average both yearly returns. However, in scenario 2, let's say we got a 10% return in both years. After the first year, we would have $110, and after the second year, we would have $121. So even though we had the same average return of 10%, the one with lower volatility resulted in a higher return. This is one of the strongest reasons why I believe in investing in international stocks. It should lower the volatility in the portfolio while increasing gains. Some historical analysis was done that looks at holding different amounts of US versus international stocks over the time period of 1970 to 2008. Let's take a look at it. This chart represents different allocations of US and international holdings, starting with 100% US at the bottom left portion of the blue line. In each box is a 10% decrease in US and 10% increase in international, all the way up to 100% international at the bottom right. And you can see 100% US yielded approximately a 9.1% return with an 18% volatility. And 100% international yielded a lower 8.9% return with almost 23% volatility. However, by combining both in the same portfolio, you can actually lower volatility and increase the return. And the optimal point is at roughly 70% US, 30% international, or 60% US and 40% international over this time period. You can see that this boosted the return to almost 9.3% while lowering or barely increasing the volatility. This is known as the efficient frontier, and it shows that there was a historical benefit to holding a pretty significant portion of international stocks in a portfolio. Now, will this benefit hold into the future? Who knows? I believe in the benefits of diversification, and I want to hedge my risk by investing in every country and every company in the world. Let's say you have decided that you want to invest in international stocks. There's a couple questions that come to mind. What percentage of your portfolio should be in international stocks, and how should you buy them? Now, the first question is really a personal preference based on your tolerance for risk. I've personally decided to go with 70% of my stocks in US stocks and 30% in international. I think it's reasonable to match the market weighting by just looking at how much money is invested in the global economy and which percentage of that is US versus international, and investing exactly like that. You can do this by looking at the FTSE All World Index and match this in your portfolio. Some people prefer to have lower international stock holdings, which is fine too. And as we saw with Joe, some people even prefer 0% in international stocks. I think you can be a successful investor as long as you pick a percentage allocation, whether it's 0 or 50, and you stick with it over the long term. One of the biggest detriments to a portfolio is when you change your strategy over time, is behavioral aspects often cause people to make adjustments to their portfolio at exactly the wrong time. Now, how do you invest in international stocks? It seems like it could be complicated. It turns out it's actually pretty simple. I'm a big fan of index funds. An index fund is a simple investment product sold by companies like Vanguard, Fidelity, Charles Schwab, or others. They're typically mutual funds or ETFs, and they hold hundreds or thousands of individual stocks or bonds. The goal of an index fund is to match the return of a market. This is different from traditional mutual funds or ETFs where you would have active managers trying to pick which stocks or bonds to invest your money in at which times. Research has shown that these active managers underperform the market. Few of them will beat the market, and even fewer will consistently beat the market. And the odds of you picking one that does are so slim that it's foolish to invest with an active manager. An index fund looks at the overall amount of money invested in a market and then divides that investment based exactly on how the market has allocated that money. So let's say Microsoft's the biggest stock, it would invest the most money in Microsoft and proportionally in smaller companies. So this is how an index fund works, and it's a great way to invest. It has some of the lowest fees, and they're very well diversified. There are 3 types of index funds that you could invest in to get international stock exposure. The first is an all-in-one index fund. These are funds that hold all of the major asset classes, like US stocks, international stocks, US bonds, and some hold international bonds. This is the simplest and maybe even best option for many investors. This would be the default option in most people's retirement plan. You simply have to buy one fund and you have a globally diversified portfolio with thousands of stocks and thousands of bonds. and you don't have to do anything. They'll automatically rebalance it every year to match the weighting they're going for, and as you age, they'll decrease the stocks and increase the bonds to lower the risk that you're taking as you near retirement. This is a simple option, and they're pretty low cost. For instance, the Vanguard Target Retirement Index 2045 Fund for people who plan to retire near 2045 costs $15 for every $10,000 you invest. And that's proportional. If you have $1,000 invested, it would be $1.50, and that's a yearly fee. It's dirt cheap considering you own thousands of bonds and stocks in this fund. The second option is similar, and it's called the Vanguard Total World Stock Market Index. This holds over 8,000 stocks across the world and matches the FTSE All World Index. The fee for this fund is a bit lower, at $10 for every $10,000 you have invested. This could be an advantage if you want to hold bonds separately from stocks or don't want bonds at all and just want one fund for your stock holdings. The third option is to hold an individual index fund for international stocks. My favorite is the Vanguard Total International Stock Index. This fund has almost 7,500 stocks in almost every country in the world but the US. The fee for investing in this fund is $11 for every $10,000 you have invested. Now that's a little higher than the Total World Index, but if you buy a US index fund, that's $4 for every $10,000 you have invested. So the difference is like 70% US at $4 and then 30% international at $11. That averages out to be cheaper than the Total World Index or the Target Retirement Index. In addition to lower fees, holding individual index funds actually has tax benefits. Different asset classes are taxed at different rates. For instance, bonds are taxed like regular income, whereas if you hold a stock for longer than a year or get dividends, it's taxed at a lower rate than regular income taxes. Many people like to hold bonds in tax-advantaged accounts like a 401k or an IRA, as it can lower the overall taxes you have to pay in the long term. And they'll hold stocks in a taxable account since they're more tax efficient, since you have to pay lower taxes on them. I can do a whole nother video on tax efficient fund placement, but let's talk about the additional benefit you get from investing in international stocks in a taxable account. Now this is only a benefit if you have money invested in a taxable account. If all your investments are in a 401k or IRA, this doesn't really help you. Your international index fund will pay taxes to foreign governments based on the dividend income they get from the companies in the index. Every year, they will send you a form that shows your portion of that tax they paid to foreign governments, and the IRS lets you deduct this against the money you owe them. It's a tax credit called the foreign tax credit. You don't get to claim this if you hold international stocks in a tax-advantaged account, but you do if you hold them in a taxable account. So this is why it can be advantageous to hold individual index funds. You get to pay lower fees, and then you get to optimize for the tax strategy. This might be more complicated than many people want, but this is one reason why you would hold individual index funds. The index funds I gave as an example were all Vanguard index funds. Other companies like Fidelity or Schwab also have great index fund products. I actually have a lot of money invested in Fidelity index funds in addition to the Vanguard index funds, and both are great. Thanks for watching, everybody. I hope you learned something about investing in international stocks. Please comment below on your opinions with international stocks, and don't forget to smash the like button and subscribe so my future content lands in your inbox. Later.